Okay, good morning everybody and welcome to the first in a three-part series of webinars focusing on a range of topics aimed at helping businesses to prepare for the post-pandemic world. My name's Simon Bonney, I'm a Managing Director in Quantima's Restructuring and Insolvency team, and I will be your chair for this morning's discussion. This series of webinars is part of the K3 Hub Training and Events Programme. Last year, as many of you will know, we merged with K3 Capital Group Plc, and since then we've launched the K3 Hub, a member network for professional advisors developed by us and other parts of the K3 Capital Group, including Intax. Free to join, the club gives members access to a whole host of services, diagnostic tools, and calculators, insights, and news and CPD accredited events via a bespoke website. You can find out more at www.k3hub.co.uk. Before we kick off, I'm contractually obliged to ask you for your patience if we do experience any technical difficulties at all during the next hour or so. And a reminder that the Q&A function is open, so please do submit any questions. I will deal with as many as we can within the time, and if there's any that are outstanding, we'll come back to you afterwards. So, without further ado, let's begin. I'm delighted to be joined today by my fellow Quantima MDs, Brian Burke, Chris Newell, and Frank Offanagaro. We're also joined by Joe McDermott, who is a Senior Tax Manager at Intax, the tax investigation specialists. We decided for this first webinar to broadly speak around a case study because we thought that would be an effective way to look at this idea of consolidation. And with that, we chose the business which is on screen now. CS is a seller of electrical goods through both stores and online channels and has a retail and wholesale business. The company's been trading for over 30 years with a traditional retail store business, currently 14 sites, but latterly it's developed an online presence, and you can see from the case study, it's got a holdco in place and then an online and a physical store. The combined business turns over 17 million to June 2020, but like many other businesses, has been severely impacted by the pandemic. Management have battled through the last 18 months, depleting cash reserves and using government support, and they are assessing the options to consolidate their position and give themselves the best platform to enable the business to survive and thrive. And so with that, the directors want to seek specialist advice as early as possible. The principle with the case study is that we will talk broadly around it, but a lot of the areas we're going to cover today will be generic in their application of the types of things that directors may be facing and the ways in which they may want to consider options for consolidation and bracing themselves for coming out of the pandemic. So without further ado, Frank, I'm going to come to you first. If you're asked to look at a business like this and someone comes to see you, the directors of CS, what are the first steps taken? What are the first things you're going to want to understand when you meet directors?
Thank you, Simon, and good morning. Yes, so typically, when a group of directors come to seek advice, I think the key thing to understand really is the background to the business. So typically you cover broader areas such as its products, its markets, key customers, and its market position at the time of discussion. You then would want to then understand what is the business's current business plan, and where is the company in route to achieving it? So how far have they gone down to achieving their business plans, and what issues may they be encountering along that journey? You typically would want to then quickly get onto what are the current pressures on the business, i.e. why are the directors there to see me? What are the current pressures, be it creditor pressure, relationship issues with the customers, potential supply chain issues? What are the pressures on this business? That would then typically lead on to what is the cash position. Now, understanding the cash position early is key to my broad analysis with management as to have we got sufficient time. I typically refer to as a cash runway. Is the cash runway long enough to allow us time to understand the financial position of the business, understand the range of options available to it, and more pertinently, have we got sufficient time to implement the preferred option?
And this, I mean, obviously on our case study, Frank, we mentioned that this is a business that has a number of months of cash available before there's a real challenge. And so there's, in this case, you know, and for a lot of businesses, we're assuming they do have time. You referenced the cash flow. Two questions, I suppose. What would you hope to see from directors at that first meeting in terms of financial information? And what would you be recommending directors are doing now, where there is that element of challenge in making sure they've got the right financial information to make decisions?
Absolutely, I think that is key, Simon. So typically, you know, with an engagement such as this, you'd want, in effect, would produce a typical information wish list, which we'd like, and that consists of financial and non-financial management information. But you know, distilling it down to the key items which I'd want management to start to prepare if they haven't already prepared the same. The first would be, when we mention about a short-term cash flow, we're really typically talking about an industry standard, quite granular 13-week cash flow on a receipts and payments basis. You know, you'd also want to see current year-to-date information, so a current balance sheet, profit and loss cash flow year-to-date. That then allows you to sense check the financial position of the business at a point in time. You would then want to get management to prepare typically a forward-looking integrated financial forecast. So integrated, i.e. linked P&L, balance sheet and cash flow. Typically, I'd want to see 2 years, because beyond 2 years, that's to get a bit more challenging. And then the final key strand of information as a minimum, which I would want to see, would be the last set of accounts, probably the last 3 years set of historic accounts. And the importance of that, it then allows you to put in context the forward-looking forecast. You could then assess and look at that within the context of what the business has historically done.
Yeah, and that's probably even more important now, isn't it? Because you're in a world where the last 18 months are not a reliable picture of what business's normal trading looks like. Yeah, absolutely. Okay, and so Chris, over to you with that. If you're, you know, if you have a business like CS, which is looking at the early options of how to manage its way out of this situation, or indeed what options it has in relation to the group generally, what are the type of options that you're likely to explore?
Well, for a business that comes early to the table for advice, it increases the amount of options that are on the table, and all should be on the table if they come early enough. And so this business is running out of cash in December, so we've got a 6-month cash runway to sort the problem out. So options would include sort of raising finance through debt, looking at some funding through perhaps equity. We'd then be looking at organising formal payment plans with creditors to assist and ease the cash flow. And we'd be looking at a restructuring perhaps of the business to provide a more stable platform for the future. What's key really is kind of understanding sort of what's achievable after meeting the management and looking at the figures, and sort of what can be achieved versus what they actually want. And we typically work very closely with the management to look to put forward these options.
And those options, presumably, so take CS here, where they have an online business which has flourished through the pandemic, and a physical business which has had real challenges. That restructuring includes presumably formal insolvency options.
It may do in certain circumstances, and there's some very useful insolvency formal options available to us. That might be a CVA, a company voluntary arrangement. There's a new moratorium that's in place and restructuring plan. So that can aid a company and the board in sort of getting through extremely kind of challenging periods. And they're part of a sort of a much wider kind of suite of options, and those would also include administration.
Yeah. Could you mind if I just jump in on that point? I think Chris makes a really, really good point. And I think, allied to all the things Chris has said as well, I think understanding the position of the key stakeholders, be it a lender or key customer, I think is also critical. And typically we would want to, as part of that options finding, engage with the key stakeholders, engage with the lenders, and if possible, see whether we can find a consensual solution that avoids insolvency, if at all possible. But I appreciate sometimes insolvency can't be avoided as a useful tool.
So I mean, on that note, Chris, I suppose what are the typical stakeholders that you're going to be likely to engage with in trying to help the business manage through challenging times?
So typically, and also kind of looking at this as a case study, we're going to have sort of a funder sort of in place. So typically that'd be a bank who's lent money and probably got a charge. So we'd be looking to engage with them as early as we could, just to explain the situation and what we were looking at in terms of options, so that they could be advised. This is a retail kind of scenario, so with multiple sites. So key stakeholders here are going to be landlords. So we've got multiple kind of landlords to deal with. We've got stock, so it's going to be sort of suppliers of the stock. What's the position there, potential issues regarding retention of title and so on. HMRC is also normally a key stakeholder. Normally they're owed sort of a fair bit of money, and in this instance, that's the case as well. So we'd look to engage with HMRC as well. Yes,
and for those who join late, we are debating a kind of a theoretical case study, so you don't need to know the details of it. It's just that practical issue of businesses that are facing financial challenges, have accrued debt. So, I mean, turning to our case study, CS has had some challenges. It's taken on government support packages in order to manage the way through 750,000 of CBILs. It's taken or made use of the furlough scheme and the VAT deferral scheme. So moving from the kind of the basics of what the information we'd want from management to actually what would we be looking at in terms of the business itself, Brian, whilst online's increased its turnover, physical has had to close stores and accrued substantial fixed costs. What are those areas in most businesses, but also specifically in a retail business, that you will be looking at when you're assessing the challenges the business is going to face and is currently facing coming out of the last 18 months?
And that's the key thing. Over the last 18 months, the vast majority of non-essential retail has been closed. During that time, it's had to try and find a way to muddle through. Yes, it's taken advantage of what's available. It's had to deal with those closures, had to deal with obviously putting staff on furlough. It's had to deal with the change in consumer habits. So, an expectation would be that the business will have rebalanced or pivoted itself. What we need to establish really early is what parts of the business are performing and can perform. Where are the actual fundamental problems? Now, it might be in the historic model, the proposition. Is that still relevant? In terms of stores, there will be additional costs in relation to not only making them fit for purpose in terms of social distancing and dealing with the cost implications associated with that, but also in terms of looking after their staff. From a stock perspective, retail can be quite seasonal. Have they actually missed a particular seasonal pitch point? What's their purchase to cash cycle like? Are they absorbing additional costs? Are they paying more for their product now? Shipping costs have gone up substantially. Are they struggling to get staff back from furlough? And of course, the other thing is there are other external impacts which are going to start to have the tap turned back on over the course of the coming months. Things like business rates will start to come back. Some of those basic issues will obviously impact the business as it goes forward, but they're also going to have to find a way of dealing with the legacy debt that's built up literally over the last sort of 10, 15 months.
Yeah, and on our figures, that's a fairly substantial debt. So you mentioned landlords in there, or you mentioned the stores. Clearly, they are an area of some debate, both in the broadsheets, but also certainly within the walls of Quantuma, as we try to understand the impact of the ongoing legislation and also where all this might end. So, I mean, in this case, we're saying that physical has landlord arrears of £2 million for the historic rent that it hasn't paid, and obviously is going to continue accruing rent. So just talk us briefly through the legislation as it stands and what the options are in relation to dealing with the arrears and the landlords?
Well, I mean, firstly, we've seen a number of moratoriums in place. Obviously, the latest one's been extended now through to March 2022. That obviously gives the company some protection from aggressive actions by its landlords. And there is obviously going to be some government legislation which is going to be tabled, apparently bringing in binding mediation, so that where landlords and their tenants can't come to a sensible outcome, that somebody will step in and stop that cliff edge from happening. Having said that, I mean, the first thing is to actually go back to very, very simple basics like, what is the makeup of the portfolio? Where's the location? How are the stores performing? Where have you got break clauses, leases? When are they ending? And what is your landlord mix? Now, one would like to have thought over the last 12, 15 months, there should have been an ongoing dialogue, certainly with the majority of landlords, a level of engagement. Hopefully they've secured a series of, ideally waivers, but if not deferrals, some degree of support. They've maybe looked at exiting certain sites. Obviously, they may have closed some already. Where are those discussions? What is the level of communication that's ongoing, bearing in mind that they do have significant arrears, and they would potentially be large issues. What I would say is that it makes no sense whatsoever to wait till March 2022 and be in exactly the same position. If you have built up significant rent arrears, what you need at the moment is certainty, so you need to engage. Landlords may well have drawn down on things like rent deposits. If they have, do they need to be replenished? Is that another liability that's going to have to be addressed at some point in time? I'd like to think that the vast majority of businesses in this particular position will have come to some degree of either formal or informal arrangement, ideally something consensual with their landlords. But there are two sides to this. One is the historic impact. I think the other one, which is also shouldn't be forgotten, is your rent roll or your rent per store, per property, sustainable going forward? So it's not only a matter of, are you dealing with a legacy debt? Have you put the position of the business in the best possible place to take it forward? Now, that may be attaching to turnover or some sort of mechanic, a reduction in contractual base rents. Have you taken legal advice on how you would tie that in? Now, ultimately, you're going to have multiple landlords across multiple sites. It's a difficult exercise to actually undertake. Ideally, you want to get to a consensual arrangement, but if that's not possible and the threat is too much, then you will have to, or potentially have to, consider the use of formal processes. Whether that be a company voluntary arrangement, whereby you can amend the terms of your lease for not only the past and dealing with the legacy, but also in how it goes forward. Likewise, the restructuring plan, with the ability to cram down landlords, or as I prefer to think of them as dissenting creditors, but one would like to think they won't be dissenting creditors. You would like to think amongst your portfolio, you would get sufficient support from your landlord base because they value you as a tenant and want someone in their stores.
And I think with that, I mean, it's obviously a well-covered area at the moment in terms of landlords and tenants, and the fact that this private creditor with a contractual right is having statute slammed over them in order to prevent them from exercising what they would consider to be powers that other people could exercise in the normal course of business if they were dealing with a supplier customer relationship. But I mean, what's your view on, I suppose, the relationship between landlords and tenants, and how effective negotiations are likely to be without a serious level of trust between the parties?
I have to say, I mean, thus far from certainly from what I've seen, and I hate to split it up, there is the good, the bad, and the ugly, and that's from both sides. Some tenants and some landlords have actually engaged very positively. Some of the institutional landlords have actually taken steps to protect their clients and their tenants. Some have actually, take for example some of the particularly large institutional landlords, they've taken some significant steps to try and smooth that runway and that path. But I think there's, I think one of the key parts from my point of view is, yeah, they're both in it together. There is a symbiotic relationship here in the sense that, you know, that the landlord wants a tenant, the tenant wants to be in the property. It's really a matter of trying to navigate from where you've been to where you want to be. Now, I think we've seen some, you know, significant changes in the way that rents are being approached. Yeah, in some instances, if you've got a high-performing store that's in a good location, and we've seen a shift in locations from people working at home from city centres to more beneficial as a regional store, you know, that may well actually over the course of time increase rent in certain areas. I think that the problem arises where you've got a mismatch, you know, where the fundamental performance, you know, of that particular unit, you know, massively underlined with what the rental value is and has been historically, and there just needs to be a reset.
Yeah, there is an overwhelming commercial practicality, isn't there, in all of this, which is there is a market rent for every premises. Landlords should be able to take back units where they're not achieving that market rent, but it's unreasonable for them to expect businesses to pay above what would be a sensible rent for a unit. Yes,
I mean, yeah, if you even take, for example, the formal process of a CBA, yeah, if you are adjusting, you know, the rent of a property, yeah, you will be offering a landlord a break.
Yeah,
okay. It's that piece of, you know, do you want to stay there?
Yeah. So, I mean, we may come back to landlords, but moving from one, well, it's a curious one. I used to always describe HMRC as the unwilling creditor because they were used for cash flow and they just sat in the background having to wait for their money. The landlords appear to have become unwilling creditor number two because whilst they used to be seen as urgent, they're now seen as someone that can sit and have arrears accrued. But moving from one to the other, HMRC, and in our example, HMRC have been very helpful in the sense that the company's been able to defer VAT to, I think we put in a figure of hundreds of thousands of pounds, 720,000, and has used the furlough scheme in order to help with their cash flow. So on HMRC, Chris, what are you going to look at in terms of, or what would you expect directors to be considering when looking at how to manage an HMRC position and especially arrears position?
What we'd want to understand, and when we're advising and assisting a board, is what's the relationship with HMRC like sort of at the moment. One of the keys in managing HMRC is communication and being in regular touch with them, especially if a business isn't able to pay what's due. And so that's one of the keys that HMRC use to assess a business. So we'd want to understand sort of, you know, what the relationship's like. Has there been communication? Then we'd be looking at, are there any sort of time to pays, TTPs in place? Has the VAT sort of deferral scheme being used? And we'd want to understand the numbers around that. So often what can happen is a company can enter into a time to pay scheme with HMRC, but really that time to pay scheme is still too short a kind of period for the business. So that's often an issue that we see. So we'd want to understand, you know, what was agreed and sort of look at that. HMRC always want their returns to be submitted and up to date, so that they'd prefer that the returns were submitted, even if the company can't afford to pay. They still want to know what the position is, and then back up that kind of return with communication about the fact that, look, we've submitted this, but we can't pay, but can we agree a kind of proposal? Are there any issues on the returns? Have they all been sort of correctly submitted and it's the correct figures? We'd also be looking at what other kind of government support has been utilised, such as the furlough, for example.
And Joe, you're our tax investigation specialist, so let's stick with furlough for a moment. And in this case, let's say that CS has some worries that whilst they have been as diligent as possible in using the furlough fund, they may have got aspects of it wrong. What do they do? What should they do?
Simon, so any business that's genuinely got concerns about how they've used the furlough scheme should be carrying out a review of those claims. HMRC has already made additional resources available to tackle non-compliance in all of the COVID schemes. And while it says its priorities are going to be on those that have set out to deliberately defraud the system, even those that have made genuine mistakes could find themselves liable to a penalty further down the line if they haven't made that disclosure early.
And what are we talking about penalties wise? If you fail to disclose, if you've made an error, say, and you then fail to disclose that error, what are the implications?
So if we jump back to the disclosure process, if a company realises it's made a mistake, they can notify HMRC within 90 days of receiving the payment or within 90 days of their circumstances changing. So if they do that and pay the money back to HMRC, generally they won't get a penalty. One way they can pay the money back to HMRC is just amending the future claim, because furlough runs up until the end of September. Moving on to the penalty side of it, we kind of need to distinguish between deliberate behaviour and non-deliberate behaviour. So one end of the spectrum, you've got sort of organised criminality and people setting up companies and deliberately defrauding the system. Those individuals and companies are likely to face up to 100% penalties. That's up 100% of the overpaying, or in the most severe cases, potentially criminal sanctions. But in this majority of cases, and like this case study, genuine errors, maximum penalty will be 30%, but we'd often be able to get that down to somewhere near nil.
But I suppose the overriding principle here is one of it's worth checking these things out now. Going back to this principle of consolidation, now coming out of the pandemic, having used the scheme, now is the time to make sure that you undertake that audit process and check whether you've made any mistakes. And then B, going back to what Chris was saying earlier and what you've said, making sure that you're transparent with your communication with HMRC, you make the right disclosures to deal with these issues in terms of quantum, even if you don't necessarily at this stage get to deal with them in terms of payment.
Yeah, so it's similar issues that Chris mentioned really. It's early engagement. If you can review your claims early, notify HMRC, and you've got up to 12 months from the company year end to pay that back. If it's a genuine mistake, you won't get penalties. So early engagement is the key again.
Understood. And in terms of a business like this, we've got £720,000 of VAT arrears, furlough schemes being used. We on the restructuring side are used to a world where HMRC are constantly asking us, how big are we as a creditor? What is our percentage? Have we been treated unfairly? Necessarily, and by the choice of the way the government has done this, HMRC are likely to be a bigger percentage of most balance sheets now because you've had these deferral schemes in place. What are you expecting to see from HMRC in terms of how they're going to deal with collecting taxes going forwards?
So, generally speaking, at Intax, most of the work we do is tax investigations. So if you're dealing with an investigations team at HMRC, it's often typically easier to get a reasonable time to pay arrangement. Once that debt passes to debt management team within HMRC, that is typically a little bit more difficult. Sort of pre-pandemic, where we might have been able to agree a 12-month time to pay arrangement, HMRC are slowly becoming more flexible, and we're seeing those terms extended to 24 months, 36 months. Going back, the key is early engagement. If you come forward to HMRC and come up with a realistic, affordable and sustainable time to pay arrangement, they're quite willing to work with you at the moment and agree a plan going forward.
Yeah, I mean, this point with regard to their mindset is I think is obviously going to be an important one. We had an interview published in our recent trade magazine with, I think, the head of debt enforcement or someone who was responsible on the debt side, who one of their statements was, we are not the enforcer. We're not here to do everybody else's work and issuing lots of petitions. Once we're returning to normal business. But Chris, I saw that you posted on LinkedIn the same day, I think, that there was a report in the paper saying that HMRC were going to be essentially as benevolent as they could be, that you were coming across more cases where they were showing signs of aggression to collect debt.
Yeah, no, absolutely. The two sort of didn't really tally. So I've seen a number of cases over recent weeks where HMRC have taken a fairly aggressive approach. And what they've done and what we've seen is they've asked a business and the directors of that business personally for a security payment for POA and NIC that's outstanding. And what they're doing is they're saying, look, this is outstanding, and we don't believe that the company's got the ability to pay. We want 24 months worth of POA and NIC to be paid as security up front. And those letters have been issued to the company and to the directors personally. So giving a month to pay, and this is hundreds of thousands of pounds worth of tax. So that's clearly a very sort of aggressive method from HMRC to take. I think they've done that because, one, they don't believe that they're going to get paid, and they might be right, and two, that they haven't got the ability to kind of petition like they normally would, sort of at the moment. And I've seen sort of 4 instances of that happen in the last kind of month. So this is clearly a kind of a tactic that HMRC have adopted for certain kind of businesses, and it didn't quite go hand in hand with what was announced by HMRC this week.
And do you think there is a pattern of what prompts them to do that? What for the advisors out there? What is there something HMRC saw in those cases, a commonality that meant that was their course of action rather than presenting a petition, or was it non-compliance of returns? Was there anything there that led you to believe this was a process?
That's a good question, and I was thinking about that myself. And I was trying to sort of think about whether it was because furlough has been utilised and perhaps the POA NIC and the furlough kind of payment hasn't been paid across. And I was also trying to think about whether it was because tax submissions hadn't been submitted to HMRC. But in looking at all the different cases, they'd kind of some of them had been paying the kind of the POA NIC and the furlough across. All of the returns had been submitted. The common theme is that there was quite high amounts of arrears due, and I think the communication had been patchy. So in picking up the common themes, it's a lot of tax that's due, and perhaps the communications with HMRC haven't been that great.
Which goes back to this point that it's important to have that line of communication with HMRC. Tell them how much they're owed if you're not going to pay them. And we have got a question here which I will deal with in a second, but just to remind everybody, please do submit any questions, and we will try and deal with them as we go on. So I have a question here from Tim with regard to HMRC and time to pay agreements, and a challenge that so Tim's a funder, and they want to try and help out in these situations. And obviously going back to this point of consolidation, why we're talking about HMRC, to try and now realign the balance sheet in order to be able to go forwards. But the issue Tim raises is one with regarding repayment plans and the fact that HMRC seem reluctant to put them in writing. For all of you, what is your experience of whether HMRC normally do, or whether there are reasons why they don't?
Happy to field that. So I'd agree with Tim in that we've come across instances where HMRC, that they'll put in place a repayment plan, but often it's done over the phone, and it appears pretty loose. And from a funder's point of view, especially with HMRC being a preferential creditor now, there's a concern about sort of the HMRC position with the kind of customer, and if a payment plan is in place, they rightfully would want to see that. And so I think it's a kind of, from my perspective, it's probably an issue with HMRC sort of personnel probably working from home, and having kind of the issues of that in not getting letters out. And what we've found is that if you do push them, they will get a letter out, and that's the experience that I've had I'm sure kind of, others on the panel have had, perhaps similar or different experiences. So it'd be good to hear some other views.
Yeah, I think just echoing what you said, Chris, I think it is definitely more of a logistic and a bandwidth issue as well with HMRC. They are resource constrained. A lot of them are working from home, so actually just easier to agree a loose plan over the phone. Having to formalize it and write it is a bit of a reach at the moment for a lot of the officers. I do agree with that.
Just quickly on that subject as well, I've seen situations where HMRC debt has been passed to a third-party debt collection agency, and even they're sometimes not willing to put an agreement in writing, even when you've agreed it 24 months over the phone.
And this is going to become a real challenge, isn't it? Because as you said, Chris, in terms of funders, for businesses to have the certainty of having the access to the right funding to get through the next 6, 12, 24 months and deal with the arrears that are being built up, they're going to need to have access to finance. And for that, they're going to need certainty in relation to what they need to pay and when, presumably.
No, I agree. And there's a pressure that you can bring to bear on HMRC there, because HMRC want the payments in. So, the customer, the client, they can go back to HMRC and say, well, look, thanks for the time to pay plan. But for me to kind of pay you, I've got to satisfy my funders. They need to see this in writing. So if you want me to start executing the payment plan, I'm going to need agreement in writing from you on HMRC letterhead. And that would probably unlock the situation quite quickly.
I think one of the other problems you can find there is the simple time frame it will take them to get that to you. Yeah. I mean, it's taking weeks for them to get letters out.
So staying on the subject of HMRC, but moving to the furlough side, obviously at the moment, I almost feel as though I need to Google 2 minutes before I say anything about the current government measures, because I'm never quite sure they'll still be in place. But at the moment, furlough is due to end in September. Frank, from your point of view, how big an impact is that going to have on businesses, and what steps should they be taking now and considering in preparation?
A good question, Simon. I think it really does depend. It is very much situation specific, but the key point that you made there, your frame is really around acting early. And again, it's consistent with the theme that we've been propagating throughout this session around acting early. Planning is absolutely key, given the seismic shock that UK business have had. So taking the furlough example, I think really what a business doesn't want to do is to be caught on the hop once the furlough payments actually ends. So my advice would be actually trying to understand, what does the end of furlough look like in terms of, do you still need the same level of capacity in terms of employees to be taken off furlough? Or will you have to make some of those furlough staff redundant? Now, clearly, as we all know, redundancy has a cost attached to it, so you would need to fund that. So I think it's really trying to understand what's the normalized capacity that you need in terms of the staff you have got on furlough. Do you need all of them back or some of them back? And then really making sure that actually you're flowing all of that into your P&L and into your cash flow, more importantly. So actually, what is the impact of furlough on your cash flow? And being able to identify now ahead of time the potential pinch points in your cash flow as a result of the tapering of the furlough support, and then making sure you've got contingency to be able to deal with that, be it getting additional funding in, or understanding your ability to manage your creditors to create a surplus cash within your cash flow. So acting early is the absolute key.
And this is a big point, isn't it? This point with regard to having the capital available to deal with what comes up with the end of furlough, with dealing with the arrears. Because from the point of view of, as you rightly said, the redundancy side, for a lot of businesses, they will be high costs. They will have a significant impact on cash, and in order for a business to cut costs, they're probably going to have to incur more short-term costs.
Correct. And it's really just understanding what that picture looks like, and indeed having various iterations of a cash flow, such in doing some scenario modeling, applying some sensitivity to cash flow as well, just to make sure you have a robust view of what the next 12 months looks like.
And I think if I can just sort of cut in and add to that, I mean, totally agree with what Frank said, but for me, this next 3-month period is going to be sort of crucial and critical to lots of, you know, SME sort of sized businesses, and because they're going to have to deal with the kind of the tapering off of the furlough, and it's expected to end at the end of September. So it's getting those cash flows correct, as Frank said, and understanding, you know, which staff you need to pull back. But also at the same time, businesses are going to have to deal with the kind of the repayments that are kicking in on CBILs loans or bounce back loans if they've taken them. And so there's actually quite a lot kind of going on. And now's the time, or you know, the previous few months have been the time to sort of for businesses to deal with this and get their kind of structure right, you know, perhaps make cuts and take advice from their advisors. So we're in this kind of critical kind of 3-month period now where the support's kind of ending and action needs to be taken.
I would add, just as an aside, also don't assume all your staff are coming back.
Yeah, that's a really good
What do you mean, Brian?
Yeah, we've noticed that yeah, whilst people are on furlough, they're quite happy to be on furlough. Yeah, but it's certainly in, you know, if you take, for example, the example business we have here, which is in retail, where people are suddenly opening stores back up, they've requested staff to come in. The staff's gone, actually, no, I don't want to work for you anymore. Thanks very much, goodbye. Yeah, they've actually found themselves alternative employment during the course of the furlough period, which they're entitled to do. And they've elected to actually stay at that particular party rather than return.
And so there's a communication issue here, there isn't there? In relation to making sure you understand what the intentions of your employees are. I saw an article in the paper recently. I think it was about a London restaurant that said it was closing at lunchtime, and I assumed that it was going to say because we don't have the clientele coming in because London's quiet. And actually, it said we're closing at lunchtime because we can't get the staff.
Yes.
And that and so there is a material point there in relation to a preparation for return, isn't there? Being able to prepare to come out of this and have a functioning business with the right level of people.
Well, the one thing that I think will assist over the next few months is obviously the fact that you can actually use flexi furlough. So you can bring people back in for 30, 40, 50%. And obviously, the pitch point for the individual will be asking them to come back, whether it be at 30%, 50% or full time. Yeah, at that particular point, you should actually know whether you've got a loyal member of staff who's returning or whether it's their intention to leave the business in any case. Yeah, but I think one of the problems has been the fact that you are very much an open-close environment.
Yes, and there has been a lot of reports, hasn't there? Certainly in the press around the idea that what the furlough scheme has done, as much as it's done good, it has created this zombie set of employees who ultimately will only remain employed whilst the furlough scheme continues.
Totally.
And no one knows what that looks like.
And that's why my belief is that that's one of the main reasons why I think the furlough will end at September, because you've got all these businesses crying out for staff, saying, you know, I can't get staff, but we've still got 3 million people on furlough. So there needs to be this recalibration so that staff will move from where they're currently furloughed to the different industries where there's a requirement at the moment.
Yes. And a question's coming here, which probably takes us back, Frank, to the forecasting side, and the sense of, you know, it's difficult to forecast, isn't it, when you're navel gazing as to what's going to happen. But Graham's question is specifically, forecasting may need to include increases in wages because of shortages of workforce. Is that something people should be factoring into? Producing those different sensitivities of forecasts and looking at what assumptions they're making?
I think that's absolutely right, and you know, and again, it comes back to your point about communication, Simon. I think it seems to be a lot that we're putting on the plate of management teams, but there is a lot for them to factor in. And I think gathering as much information about the general market conditions within or employees and supply of employees within which you're working, but also as well, get to Brian's point, getting that early sense within your workforce on furlough as to, what's the level of demand can you service, and what level of employees are you going to get back? Now, actually, to tempt them out of this kind of furlough to keep them within the business, you might need to factor some kind of, it sounds a bit perverse, some incentives, to actually get them back into the business. But again, I will undoubtedly say forecasting in this environment is going to be really, really difficult. And actually, I have a say, in almost every forecast that's going to be made is almost going to be wrong. But I think we are in a best guess scenario, and to be able to do that, you need to gather as much information as you can about the intentions of your staff and about the wider market. So yes,
and that point about the challenges of it. I mean, presumably the key to forecasting is about understanding the assumptions you're making and understanding why they may be right or wrong when you're producing an alternative forecast.
Absolutely right. Absolutely right.
And also revisiting it regularly to make sure it's current and up to date.
Yeah. Okay. So I mean, we know that debt is a ever growing issue of the pandemic, both at UK level, but also in relation to businesses that have got arrears, that have taken on CBILs, BBLs, and that support only goes on so long. So, Brian, from your point of view, if you're going to restructure that balance sheet, if you're going to try and manage that debt position and be able to trade out, apart from generating huge amounts of revenue in order to deal with it, what are the options in terms of future funding?
Well, I think firstly, the one thing I would say is self-help is always a good start. I think most businesses start to need to look at their cash utilization. Can they improve their cash cycles? If they've got debtor books, can they actually get money in earlier from their customers? Can they improve their trading terms with suppliers? Can they negotiate a longer period in which to pay? Can they release cash from old stock? Simple things in terms of either preserving, conserving, or generating cash within your own environment. Once you've actually looked at those options, and I suppose those ones are the ones within your control. Hopefully, you'll be able to get firstly, an understanding of exactly what you need. So it's not what you want; it's what you actually need, and also what it's required for. So it's that piece of being able to say, actually, I need X amount of money to achieve this. This is how it's going to be utilised, and actually, obtain that cash and then deliver what you're actually going to do with it. Once you get to that particular point, then obviously you've got to take a view on whether it really is equity or debt. Should you be looking to the existing shareholders? Should you be looking to bring in new shareholders? Are your existing stakeholders prepared to give you loans? Are they prepared to put more equity in? Can they put in some sort of structure? What are you going to use that with? Is that a repayment of an element of debt, or is it to actually utilise in the business? If you're going to be looking for external funding, obviously there's government schemes still available. The recovery loan scheme, I think, is now open until December 2021. Obviously, it's going to be at the discretion of any participating lender. Likewise, if you've got an existing lender, you want to engage with them. Now, your structure for debts, as it currently stands, if you've got CBILs, BBLs, overdraft, or whatever, is that now fit for purpose for your business? Is it actually a requirement to have more money, or is it actually a requirement to have, for example, a working capital facility? So you've got a revolving facility rather than a debt-based term loan. Something that actually then works in the trading cycle of the business. Now, okay, for a retailer, it's much more difficult. But if you've got a wholesale side, then you may be able to leverage that to actually generate that. Whether it be that you're looking at invoice discounting, or even, for example, if you're looking to release cash, maybe by refinancing existing assets. Do you have assets there that you can actually refi, generate some cash, put that into the business? Obviously, appetites will always vary from lender to lender. But it's a matter of also being able to demonstrate the company has the propensity to actually service that debt. And that goes back to, again, define the need, define what it's going to be utilised for, and then demonstrate the fact that you can support it.
And so just on BBLs and CBILs for a moment, I mean, what's your view in terms of whether there's going to be any renegotiation in the future on the flexibility of those loans, or is it, you know, fixed term and done?
Well, no, I mean, BBLs, yeah, the pay-as-you-grow scheme, yeah, that now allows you to extend BBLs from 6 years to 10 years, yeah, which is a substantial additional period. Yes, it will cost you more in interest, but also with BBLs as well, you can have a 6-month repayment holiday where you pay absolutely nothing for 6 months, or during the term you can have 3 periods of 6 months where you're paying interest only. So yeah, they're calling it pay as you grow. I think as time goes on, it'll become pay as you grow. Yeah, but that's just my view of it, because yeah, why would you want to have a 10-year term loan? Yeah, but yeah, if the yeah, and I appreciate the fact that it's adding flexibility. There will be, let's call it a softer landing and so on and so forth, and it's a great way to work with businesses. Yeah, but ultimately you're a business, so if you have debt, you want to repay it and move out into a different cash cycle. With CBILs, obviously it's slightly different. CBILs, and certainly with the Corona large, loan scheme, they're very close to new applications in March 21. They are, I guess, part of the lending mechanisms and defined by the lender rather than by the government. Whereas obviously BBLs is very much a government-led, I suppose, strategy in terms of that extension. For some people, they've refinanced existing facilities onto CBILs. For others, what they will probably do over the course of time is engage with their lender and probably restructure their CBILs, in part to actually bring in other lines. But that will be open discussions with their lenders, who, at the moment, as far as I can see, have got they've been very effective in getting cash out into the market. I'm pretty certain they'll be working very heavily with their clients to ensure they get from where they are now up on their feet and hopefully moving forward again.
Yeah, and obviously you mentioned in this the one option of funding being equity, and that could be via a minority shareholding. But clearly the other option, which is on the table for any business, and it may be that there are some management teams out there who are so frazzled that they just can't face this anymore, is to look at selling your business. So Frank, from your point of view, when is that an option? Is it always an option? And what are you looking for?
Yeah, I mean, I would say it's certainly an option that I'm always duty bound to explore with a management team when I first meet them. And clearly you have two business divisions there. You're like, well, online is clearly the more viable business. So actually, in terms of any discussions about a going concern sale, that seems the more plausible option. Clearly, it depends on where the shareholders are in terms of actually have they met their exit hurdles or not, or given the uncertainty, do they think actually we're going to dampen down our exit expectations in terms of value and just sell now? So it really very much does depend. In terms of the physical business, which is clearly the more challenged business, clearly a going concern sale wouldn't be applicable here. But again, depending on where management are, they might want to explore an accelerated, M&A process where perhaps they do pre-pack type disposal. We don't depend on where the shareholders are in terms of their views.
Yes, understood. And a question for all of you, but I'd like to start with Joe on it. One of the areas that it seems to me that businesses are going to be tempted to consolidate is in moving around assets. Take a case study like CS. We have on one side a business that's doing relatively well, on the other side a business that's struggling, and it's probably a dinosaur in terms of its model as it was. But because of the historic nature of the business, you might find that the goodwill of that business, for example, is in the old business, the physical business, and not in the online business. I think there's a lot of factors to take into account, but I suppose looking at it from a hindsight point of view, and Joe, for you first, what's your expectation in terms of HMRC's appetite for investigation of what companies have been doing and what and especially actually with recent legislation, what the government's going to look at in terms of investigating companies that have just closed down. I mean, do you expect to see a lot more tax investigations to understand what, for example, with furlough, how was the money taken in? How was it used? Was it used properly?
Unquestionably, there's going to be an increase in investigations. HMRC will probably start tackling down hard on the COVID-related schemes. So they might go in and find out there's something wrong with a furlough claim, and that is inevitably going to lead into other aspects of the business. Once they've realised that there's potential issues there, are there issues on the VAT returns? Are there issues on the corporation tax returns? So, yeah, they're all sort of going to be interlinked. And once HMRC identify one issue, it often does lead into a bigger inquiry and identifying other problems.
And HMRC are obviously one party who will have a vested interest, both because they're likely to be large creditors, but also because they have a preferential status. Frank, Chris, Brian, from your point of view, the lender side, are you seeing increased activity in terms of lenders being interested in what's happened to the money that they've lent over the last 18 months?
It's increasing. So lenders are aware, obviously, that HMRC has got the preferential status now. They're concerned, and from what we're hearing, they're looking to understand the HMRC position for their customers perhaps a bit more eagerly than they might have in the past. They'll also be looking to potentially take extra security over assets so that they've got fixed charge security, and that they're not just relying on floating charge security. So I personally think there's going to be sort of challenges for SME kind of businesses in obtaining kind of future kind of funding because of this. So it's definitely on the radar of lenders.
So Simon, if I think you were slightly asking the question you were asking, I thought was really around in terms of where CBILs and BBLs have been lent out by lenders, whether they have any concerns as to utilization, which is slightly different. So I mean, from my perspective, so I guess it really depends. So on the BBL side, what I'm hearing is, given the relative small side of the loans, I've heard anecdotally that banks are thinking, well, we're almost providing for the large chunk of those loans which have already lent out, because almost the expectation that is too small to try to actually recover from a workout scenario, clearly in terms of utilizing the bank's resources, or the expectation that a large chunk have been misused, and the appetite to go after an individual just isn't there for the bank, so they're almost providing for those loans. In terms of the bigger CBILs loans, again, I haven't really got a sense as to whether lenders are minded to really hold individuals to account where they have been misused or not. I don't know whether Brian said anything on that point.
Well, I think, from my point of view, lenders have always been interested to understand what the money is being used for, and to try and protect their position as best possible. Most of that comes through from the relationships they have with their clients. I think one of the biggest challenges created by, I guess, HMRC, the value of debt that's increased in terms of HMRC, the deferral schemes and so on and so forth. It's simply the fact of, you're already, as a lender, you're already invested. Your money's in there. What you're trying to do is now understand how you're going to get it back. And I think one of the biggest concerns I've got at the moment is that there are so many businesses who still are not in a position where you can get clear sight on where they are and where they're going. And if you could get confidence in that, and the management can deliver their strategy to get the business from point A to point B, then your level of interest sort of dissipates to a degree.
Yeah. So I think that's all we have time for. Thank you very much, everybody. I mean, from my point of view, the takeaway, like it always seems to be, is get the right advice at the right time. And for a lot of businesses out there, they're going to have balance sheets which have probably stood still on the asset side, if not depleted, and on the liability side increased. And so to work the way out of the situation and, for example, move assets around between groups, it's always important to take that professional advice. So thank you so much to all of those who joined us. Don't forget, this is the first of 3 webinars taking place over the next month or so. On Friday, the 16th of July, we'll be discussing restructuring and dealing with dormant businesses, tax strategies to maximise value, and working capital requirements. On Friday, the 30th of July, the final webinar will be looking at diversification, raising finance and transactions. Please do take a look at our K3 Hub website, www.k3hub.co.uk, where you can find more information and a link to register. But we'll also send you an email with further details just as a prompt. Thank you very much to Frank, Joe, Brian and Chris for taking the time to share their knowledge, expertise and experience for us. And we hope you found the webinar useful, and please do get in touch directly if you would like to discuss anything in more detail. See you next time. Thank you very much and have a great weekend.
Thank you.